Well, the Nasdaq hit yet another record on Friday, trading very close to 5,100. Now, back on March 2nd, the Nasdaq hit 5,000 for the first time since 2000, and that, of course, was the year of the dot-com bust. So, is there more room for growth left, or is a tech meltdown on its way? David Nelson is the chief strategist at Bell Point Asset Management and joins me now on set. And David, you say?
That's quite a lead in there. First of all, look, those who are calling that this Nasdaq, the same bubble that it was back in 2000, they probably weren't there then. I was, and I can tell you that there's no comparison at all. Back then, you know, many of these companies weren't even generating revenue, much less earnings. So. I don't think the comparison is really real. Are there some similarities? You know, sure. There's a lot of stock options, a lot of stock-based compensation. A lot of those similarities are there. But these companies are earning money. They're growing revenue pretty handily, and you're seeing it in some of these big growers like a Facebook. Even Google is, you know, had a fairly decent quarter, and I've been a pretty big critic of Google as late.
So there's some meat to substantiate.
Sure, there's some meat out there, and then we have some legacy companies like the Amazons from back then, who still aren't earning any money, but the market seems to discount that because they believe that someday they will cut their expenses and actually start to earn money. Microsoft is, you know, trying to move to the cloud. They're having a pop this morning, and that's the buzzword that everybody tries to use. When you get in trouble with your company and you're trying to turn it around, you start to say that you're moving towards the cloud, and that's supposed to bail you out.
It's not just the Nasdaq. All the other indexes are near record highs. So
they are, but there's a pretty big separation right now. If I look at the tape right now, it's almost like there's two markets. You know, you have the old industrial complex, and you've seen it in Union Pacific, Kansas City Southern, Norfolk Southern. And then the industrial complex with companies like 3M, even General Electric's numbers weren't that great. And then on the other side, we have the Nasdaq, which is screaming right now, most of it. But as I came in this morning, there are some pockets of concern there. The semiconductors are getting hammered today. Now that's not a bright spot for the Nasdaq itself. So it's being held up today by Google and Amazon and Starbucks.
But this bull market, though, has been going on for 6 years now. I mean, how much longer can that continue?
Look, I'm not an uber bear. You know, I'm not looking for the crash, but I think the market is struggling right now. And yeah, we may break out to new highs, and then we'll get another retrenchment. And we've been seeing that all year. There are pockets of strengths, and there's certainly places to put money. But when you look at the broad indices, you know, I would venture a guess after today's durable goods number that just came out, which was pretty poor, I think economists are going to start ratcheting back GDP. And we're probably looking at a sub 1% GDP number for this quarter. So whatever's going to happen after we get beyond this earnings recession, it's probably later in the year, and it's probably third or fourth quarter we're going to get the bulk of the move.
All right, and just real quick, what should investors be doing? What's your playbook?
My playbook. Look, I own a lot of the same names that I have right now. It's a struggle. I'm not going to lie to you. It's a struggle out there trying to find stocks. One name that we talked about last time we were here was Lyondell Petrochemical. They did report today. It's done well off the bottom, like some of these chemical companies and some of the oil. But, you know, earnings were great, but revenue, big miss.
All right, David, thanks very much for coming in. I'm Scott Gam, and you're watching The Street.